Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 173 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about CDs. And for those of you who are millennials, not the ones that you pop into your car or pop into your CD player, no, not those CDs, certificates of deposit CDs. And I've spoken a little bit about CDs before, but I had a recent question about CDs, and so I think they would be a pretty good place to camp out for an episode and allow you guys to learn a bit more about CDs and learn what I think about CDs and how they are not the investments that many have touted them to be for years and years. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, there are a lot of investment types and investment practices and ways to invest that we can take directly from those that came before us. A lot of people before us have done things in the correct way, and those things will continue to work over the long term. But one thing that is not going to work in the future, that has been heavily touted in the past, and your grandparents might still hold these. They may have, put money in one of these for you. There are many reasons why somebody would have chosen this investment option, and they can still choose this investment option, and you could still choose this investment option, but that does not mean that is where you need to sock your money away, and that is the certificate of deposit, or the CD, right? The CD is a bank product, right? It is a product offered by banks and credit unions that provides an interest rate, some rate of return in exchange for you agreeing to leave a lump sum deposit, leave a lump sum of money at the bank for a fixed period of time, for a certain maturity. And it's basically you lending money to the bank, okay? Now, certificates of deposit are some of the safest investment vehicles out there. There is rarely anything that is going to match the safety and security of a certificate of deposit. But does that mean that we need to invest in a certificate of deposit? Well, overall, my answer for today is going to be absolutely not. We do not need to be socking money away into certificates of deposit for multiple reasons, and we'll get to what those reasons are. But even if we have money in them, it's probably better that we take that money out, even if there's going to be some cost to doing so. And so we'll jump into exactly what these are, what they look like, and how we can go about dodging them or even using them in a minute few situations that could be beneficial to us over the long term. So how does the CD work? How does a certificate of deposit work? Well, opening a CD is very similar to somebody opening any standard bank account, right? You can go to a bank or you can go online and you can open one of these accounts. It's not that difficult. It's not going to take that long. The difference is what you're agreeing to when you sign on the dotted line. Instead of putting money in a bank account and being able to transact from that bank account, when you put money into a CD, you have to leave that money alone for a fixed amount of time. A lot of CDs are, 12-month, 18-month, 24-month, 36-month type CDs. And quite clearly, as you let them hold your money longer, they will give you a better rate, right? They will give you a better rate for holding your money a longer amount of time. And so the way that these are set up, right, you can go online and shop them from several different banks. It's not going to differ a ton because the interest rate that is inherent to these CDs is directly tied to what the underlying interest rates are, what the federal funds rate is, what the discount rate is in the market. And so the interest rate, these rates are locked in and they provide a clear and predictable return on your deposit over a specific period of time. The bank cannot later change the rate and therefore reduce your earnings. So, if you have a savings account, right, and especially if you've had a savings account over the past, 12 to 18 months, you have seen that as rates have been dropped by the Federal Reserve, then the rate of interest on maybe your high yield savings account has also dropped over the past year or 18 months. But with a CD, that cannot be the case. With a CD, it is locked in. Now, a fixed return may hurt you, and that is one of the reasons why that on a broad scale we want to stay away from CDs, is because a fixed return can hurt you, and especially a low fixed return can hurt you if rates later rise and you've lost your opportunity to take advantage of higher paying CDs or just higher paying investments in general. And so there is this interest rate, and then you sign up and you get paid this interest rate over some term, right? This is the length of time you've agreed to leave your funds deposited to avoid any penalty. So 6 months, a year, 18 months, like I said a moment ago. The term ends on what we call the maturity date, and that is the date at which you can take the money out of the CD without any repercussions, without any penalties or anything of the like. Your CD has fully matured and you can withdraw your funds penalty free after that maturity date. And so this is the restriction of the CD. The restriction is you must stay in it until the maturity date of that CD, or else you will be charged some type of penalty. And so the other two parts of the CD equation, there's the principal amount. So with the exception of some specialty CDs, this is the amount you agree to deposit when you sign up for the CD. So you agree to deposit some amount, and typically the higher amount you deposit, you also get a better interest rate. So not only the longer length, but the higher amount that you deposit, you'll get a better interest rate on the CD. And typically what's going to occur is that you're going to have to put in a lump sum up front. You can't systematically add to the CD. Now, there are some CDs that will allow you to do that, but those are the exception and not the rule. The rule is that you have to put in some principal value, and that is the value on which your CD cost basis is determined. Then you have the principal, so you've got the interest rate, the term, the principal, and then there is the institution. So the bank or credit union where you open your CD, they will determine the aspects of the agreement, such as the early withdrawal penalties, right? They may have specific penalties to that specific bank, and whether your CD will be automatically reinvested if you don't provide other instructions at the time of maturity. So that is also a danger of CDs. A danger of CDs is if you don't give specific instruction, in a lot of cases, they will just roll it into another CD. And if they roll it into another CD, then you're stuck for another certain period of time. And being stuck for that period of time means that you can't make returns elsewhere with that money without being charged the penalty that was inherent to that institution. And the penalty, the size of the penalty charged by the institution is going to also have a lot to do with the type of institution that you're working with, whether it's a bank or a credit union, whether it's a regional bank or a multinational bank, things of the like in that way. So you're going to have a lot of things that are dependent on the institution. But overall, what you have is you have this place, right? This account where you are putting money into in a lump sum amount. They are going to pay interest into that account in a fixed way over a fixed amount of time. And you are doing so at a bank or credit union that may have specific rules on the penalties for early withdrawal and the way in which they deal with your interest payments. Okay. So in general, that's what a CD looks like. A CD is exactly that. Now, seems harmless. But in being harmless, it can also be dangerous to your money. I'll just throw this out there. If you are, in your 20s, 30s, 40s, maybe even 50s if you're not retired yet, a CD is a bad idea. And in general, even if you are retired or even if you are up there in age, CDs are bad ideas. And one of the biggest reasons that CDs are bad ideas is because of the interest rate that they pay. They pay absolutely low interest rates, okay? And that is relative to the prevailing interest rate in the market. Now, Why did our grandparents and maybe even parents invest in these things and maybe still have money in these things at this time? Because back in the day, CDs, you could sign up for CDs making 9, 10, 11% because interest rates were much higher back in the 80s, right? And even in the 90s, interest rates weren't extremely low, but they're far higher than they are today. And so these interest rates, when they were higher, the CDs look more attractive because, hey, if I can, get a guaranteed 9% from the bank, I think I'll sign up for that. I'll sign up for that, annualized guaranteed 9%. But nowadays, CDs that offer you, just a couple of percent, maybe, right? Really less than that at this point for most banks, are really not worth your time because even though there is extremely little risk, you are tying up your money in something that is not going to increase in value for you, that is not going to allow your money to compound adequately into the future, and that is not going to benefit you. Now, you may say, well, but it's safe. There's so much safety involved in a CD. Maybe I like the safety. Listen, there are other places where you can get adequate safety, right? Maybe not the guaranteed safety of a CD, but heck, if a bank fails, then good luck getting the money from your CD. But there are a lot of better places to put your money that will give you better returns. Now, may you need to take on a little bit more risk? Well, God forbid, yes, you might need to take on a little bit more risk, but you can still get safer returns in other places. You can get safer returns in places like bonds and places like preferred stocks. Preferred stocks are actually going to be what we talk about in tomorrow's episode, right? But running to a CD because it's going to provide safety is just not worth your time. It's not worth your time because growing your money that slow, you might as well put it in a bank account and let it be in a bank account where you can actually access the money, right? But obviously, as the rates on CDs change, their attractiveness changes. But if interest rates are going to remain perpetually low in the United States, then the number of people that are running to CDs is going to be declining significantly, or is going to stay down based on what it already is, right? These low interest rates do not bode well for somebody who is going to sign up for a CD. And so what we have to make sure of, one way or the other, is that we are growing our money. We've talked about, when you're investing, the whole point is to get to a certain point where you can live financially free on the nest egg that you've built. And if you're trying to build a big nest egg with CDs, you're likely going to fail, especially if you're doing it today, right? When you're putting money into CDs today and trying to grow money that way, you are going to fail. It's not going to work out well for you. And so why would you even open a CD? In what situations would it be beneficial for somebody to open a CD? So the best candidates for putting money into a CD, and I'm not saying that you should if you meet these criteria, and I'm just saying that these are the best candidates. The best candidates are those that have a low tax bracket. They're in a low tax bracket. Because if you're in a low tax bracket, then you don't have as much worry about the capitalized interest on the CD, because when you have a CD that's not in a tax advantage type holding, right? Because you can hold CDs within IRAs, which are tax advantaged, but then that puts another layer of restriction on that CD. But if you just hold it as, you would have a bank account, right? But you have this CD, or as you have a brokerage account, once that CD matures and you have the CD cashed out, then you are going to have to pay the either capital gains tax or short-term capital gains on whatever gains you may have made in that CD. So being in a low tax bracket is useful there. If you want zero investment risk, like we talked about a little while ago, it is just, I just feel like there are better ways to go about finding lower investment risk, but there's really no investment risk to a CD because you're not investing in something. There is no underlying asset in which you're investing. You're literally just loaning money to the bank at a low interest rate. And then if you have a primary goal of preservation of capital. Now this makes a little more sense, and I'll tell you why. Because if your goal is to just keep what you have, then CDs start to make a little more sense. And especially if CD rates rise a little bit, they begin to make a lot more sense. Because if you're somebody who just has you've built a nice nest egg, right? And you're not actively needing to use all of that nest egg, right? I'm somebody who I'm perfectly fine with leaving my money invested over the long term and not taking too much risk off the table, even though taking some risk off the table is necessary over time as you get older, as you push into retirement. Taking a little risk off the table is going to be not 100% necessary, but can be helpful to preserve the capital that you have. But if you wanted to take a piece of a large nest egg and put it in a CD, then you could be in a place where you could preserve that capital better. But there are just so many better ways that you could actually earn interest. You could earn money and still take very little investment risk and still preserve the capital that you have without taking huge outsized risks. So even though that can be the case, I just don't know what situation you would want to go about doing that. Now, if you wanted to put some of your money into something like treasury bonds, right, and short-term treasury bonds or something of the like, and you found that you could have a CD that could pay higher than short-term treasury bonds, and you're willing to put that money away and sit it on the sideline for whatever fixed period of time, then that may be okay, right? If you're offered an adequate rate, if you're offered a 3-4% rate on a CD, which are just unreal high at this point, right? You're not going to find those at this point in time. But in the future, as rates rise, it's likely that you could end up finding something like that. And a good candidate for a certificate of deposit is going to plan to use the funds at the time that matches the CD maturity rate. Because anytime you have something that you're going to hold to maturity, it's good to have some goal at that maturity date. So I'll give you for instance, right? If you have calculated that the cost of your kid's college is going to be, let's say, $50,000 or $60,000 when they decide to start school, and you have that amount of money invested now. You have that amount of money ready for them, but let's say it's going to be 18 months or a year or however long until they actually begin school, then you may look at something like a certificate of deposit as a place where you can put that money away, make a low interest rate, and guarantee that that money is going to be there at the time that the CD matures. And so that could be a way that you can make sure that you preserve capital in the short term. Again, these are not good long-term investments because they are going to lag, obviously, the stock market. They're going to lag the bond market. They're going to lag any type of substantial, normal investment that you would think of. And so they're not a good investment in that way where they're going to make an adequate rate of return, but they are going to preserve capital well. And so if you have a need to preserve capital over the short term, this may be a good alternative for you. It may be a good place for you to sock your money away. But it would have to be short term. It would not have to be for the reason that you think it's going to be a good investment relative to your other investments. But it's just going to be to make sure that you have the money where you need it when you need that money. And then another good candidate for certificate of deposits would be someone who can lock in a higher rate of return than inflation over time. Look, we haven't even talked about inflation, and that is a huge issue when it comes to any type of fixed asset. When it comes to any type of fixed income asset that you may hold, such as a CD is a fixed income asset because they are paying a fixed amount of interest. And so if whatever that CD rate is below the rate of inflation or the average rate of inflation, then your money is actually losing value over time, right? If you had held money in a CD over the last 12 months, you would almost be guaranteed to have lost money relative to inflation. And that's just based on the fact that we're getting the real picture when it comes to the inflation that is being stated by the federal government, because it just doesn't seem realistic that we've pumped as much money into the economy that we have and that our inflation hasn't blown up more than they said it has. Maybe the basket of goods on which they're trying to calculate this inflation is not the basket of goods that they should be using. But I digress from that. I'm just saying you have to be able to lock in a higher return than inflation or you are losing. You are not doing anything to maintain the principal value of your money if you are letting it get eat away by inflation. So we do not want that. We want our money to be growing, not falling behind. So that's a good candidate for a CD. And even in those cases, I wouldn't personally choose a CD, but if at all, if you were ever going to choose a CD, only in those cases, right? Only when your life matches up and your needs match up to the scenarios that I just read out. Now, who are bad candidates for CDs? Okay, now this is most of you, and I would argue maybe even all of you, but who are the bad candidates overall? Well, CDs are likely a poor investment if you are losing money after you factor in taxes and inflation, right? If you factor in inflation and you factor in the amount of money that you paid in taxes and the value of your money has decreased while having it in the CD, then that was a bad idea, right? That's why I say that the longer you hold CDs, yeah, they may offer you a little better rate, but putting money in a CD over a long period of time is not going to be really useful because taxes and inflation are going to eat away at your money. If you have a primary investment goal of growth or income, then CDs are a bad idea. Now, why is this? Well, we'll start with income because CDs do not pay you any income. Yes, they pay interest into the account, but you're not paid a dividend or a direct coupon payment or interest payment like bonds do, or some dividend like a preferred stock may pay you. But you simply just have money coming in to the account on whatever it may be, the annual basis that they may put your interest in there, or the monthly basis, whatever they choose to do. And so that is the income side of things. But if you need growth at all, run away. Run far, far away from CDs. Run far, far away from certificates of deposit because they're not going to grow the way you need them to grow. It's not going to be satisfactory because, again, we are not investing in the performance of anything at this point, right? When you're investing in a stock or a mutual fund or an ETF or some index fund or bonds or whatever, you are basing your investing on the performance of some underlying asset, being a company or a group of companies. But when it comes to a CD, you're simply saying, hey, bank, can you pay me back this small amount of interest, right? You're probably better off buying the bonds of whatever bank that you are getting the CD from instead of just buying a CD from that bank. But you are not going to grow the way that you want to grow. We've talked before about how the average return of the stock market over the long term, the S&P 500, has been over 10% per year. Okay, you're not going to find that over the long term with CDs, and you're definitely not going to find that right now with CDs because for this week, right, the CD rates are extremely low. Right, I've talked about averaging 10% a year in the stock market. Well, if you get a 1-year CD, then you're going to make on average 0.19% annually. That's nothing, and you factor in inflation, you factor in taxes, the value of your money went down. 5-year CD, 0.32%. You're going to lose your money, right? Your money's going to go down in value. Even things like money market accounts right now are paying nothing. Savings accounts paying nothing, right? You have to make sure that your assets are working for you. You have to make sure that your assets are out there growing for you over the long term. If you're just sitting them in a CD and they're going down in value, then that's not going to be useful for anybody. Now, some of you may say, oh, well, could I put something like my emergency fund in a CD? Bad idea. And here's why. Because a CD is a fixed maturity instrument, right? And you have to hold it until maturity. And so if you don't, you get penalized. Well, I don't want to be penalized on just getting my hands on my money if I need it for an emergency. So that is not a good idea. You want your money to be available to you in a high yield savings or a money market account when you are trying to build up an emergency fund. And so these are just not good ideas. And I did not even realize they were paying as low as they are. I mean, it's nothing. And if those rates increase over time, they may actually become attractive in some of those situations that we said, individuals who could be good candidates for them. That might be a legitimate option, but right now, I just don't see any reason that you would put money into a CD above any other type of financial instrument. But another bad candidate for a CD would be somebody who needs to be able to withdraw their money at any time. Like we said, with an emergency fund or even your checking account or whatever, right? Don't just be putting that money into a CD. If you're going to need the money, then don't lock it up, right? Don't lock it up in a CD or any other type of anything that's going to require you to keep money in there over some period of time if you know that you're going to need access to that money. Look, it's just not a good idea. CDs are an illiquid investment. That means you cannot easily get your hands on your money. Anyone with liquidity needs would be a poor candidate for long-term CDs. And anybody with growth needs or income needs, or anybody who worries about taxes or inflation, which we should all be worrying about taxes and inflation, those individuals need to stay out of CDs as well. And so that really knocks all of us out, right? It knocks most of us out of being somebody who would be good candidates for CDs. But I implore you, if you have them, rethink it. If you have them, think about the possibility of just paying the penalty and then reinvesting that money. Because in a lot of cases, the penalties aren't abnormally huge. And in a lot of cases, the penalties are just going to be a part of your gains, whatever those gains may be. And the taxes may be part of the gain. Well, there are no gains right now. And so please rethink it. Look, think about other types of low investment risk investments that can allow you to still grow your money and keep up with inflation and not have to pay taxes and inflation and then have lost money. I don't want you to have to do that in real terms. I want you to be gaining money in real terms and beating inflation by a good clip. That's what we want to be doing when we are investing. And if anybody's trying to invest for the long term, CDs aren't it. If anybody's trying to grow their money over the next 3, 4, 5 years, CDs aren't it, right? These are only capital preservation instruments, and they really aren't paying anything right now. So I don't even see why you would want to put money away in them. But it is a good conversation to have because these are heavily marketed by banks. You see them on bank marquee signs. You go to your bank's website, you're likely going to see CD rates. They want to sell these because they want to borrow your money, right? The banks want to borrow your money so they can lend it back out at higher rates than the rate at which they are paying you for that CD. And then they'll just return you your little bit of interest, but they made significant interest on the money that you lent them. That's why they want the principal amount, that lump sum amount, so they can go out and lend that money out again. Look, the banking system is going to make their money, and CDs are just a simple way in which they do so. And I mean, you could even argue that our savings accounts and our checking accounts are a way that they do that as well. And you're not wrong. But CDs are a locked in way where they know how long they're going to have their hands on that money at minimum. And they can go out and do whatever they need to do with the money that you've given them at a very low interest rate. And so don't become a fool to the system. Don't become a fool to old ways that happened to work at one point without looking at the facts, without looking at the fact that CDs just aren't adequate investments for the vast majority of individuals. I won't be putting money in CDs anytime soon or ever for that case, but you never know what future interest rates are going to be and how attractive that may be later on. Again, you just have to keep your mind open. You have to be able to know the facts at the time. And the facts right now are that CDs are not worth your time. They're not worth your money. And I would, by and large, stay away. Okay, and I'm glad that we better understand now what CDs are. I'm glad that you can walk away from this maybe understanding that, hey, there are these financial instruments out there that aren't necessarily good for our goals, but you also need to know if you see them at very attractive rates later on, and they may seem like something that you want to be a part of, maybe to preserve capital for a short period of time. Then you can actually make an informed decision and know what a CD is, because being a good candidate or a bad candidate for a CD is not going to change if the interest rates or the maturities change. That is only going to change if your life changes. If your situation changes, then you can make those decisions for yourself and hopefully make the right ones that are going to help you to reach financial freedom over the long term. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video. Leave me any feedback in the comments down below if you haven't done so already, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long-form episodes on YouTube and the podcast every single day. And if you need somebody to keep you accountable to a financial plan and help you to create a financial plan that's specific to you and your family's needs, then I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about another type of investment, a preferred stock. And I'll talk about why this is different from a common stock, and why these types of investments could be useful for you and your family. So tune in to that and learn a little bit more about another type of investment. So thanks for tuning in to today's episode of Money's No Object. I'm your host, Dylan Howell. God bless.